This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Sunday, August 2, 2026, and this is the After Hours session. Now, let's get into it. The VIX just closed at 15.99, a number that feels dangerously low for an environment where the fear and greed index has collapsed to 14. We are sitting in a market that is technically risk-on according to regime models, yet sentiment is screaming fearful. This is the disconnect that defines the week ahead. With the Bank of England decision on Thursday, August 6, and a heavy U.S. data calendar, including ISM manufacturing and durable goods, we are entering a high-stakes week for FX. Let's see if the charts and flows can reconcile this divergence. Good morning. Let's look at the macro backdrop. The Federal Reserve is currently holding the effective rate at 3.63%, right in the middle of the 3.5% to 3.75% target range. The yield curve is non-inverted, with the 10-year 2-year spread at 0.47%, which is a healthy, normal slope. However, the 10-year 3M spread has surged by 26% to 0.92%. This steepening at the short end is the most critical macro signal right now. It suggests markets are pricing in a potential shift in short-term rate expectations, possibly easing.
I'm looking at the price action and the structure is telling a story of sharp reversal. Let's start with euro-dollar. 5 days ago, we saw a low of 1.13533. By yesterday, July 31, the pair had rallied to a high of 1.15475. That is a 200-pip move in 4 days. Today, however, the price is stuck at 1.153, essentially flatlining. The 5-day high of 1.15475 is now immediate resistance. If we break below the July 30 close of 1.1523, we retest the 1.1467 area.
Let's look at where the smart money is actually positioned, because it contradicts the headline fear. The COT data for the week ending July 28 shows something extraordinary. Commercial hedgers, the institutional smart money, are at the 100th percentile for net long positions across every major FX pair I track.
I'm here to stress test the consensus. The consensus right now, based on the 100th percentile commercial longs and the risk-on regime score, is that this is a buy-the-dip opportunity. I disagree. The risk is not a bounce. The risk is a trap.
Let's tie this together. We have a macro environment that is technically risk-on with loose financial conditions, but sentiment is at extreme fear, 14/100. The charts show a sharp, violent rally in risk currencies, pound, RC, and a sharp drop in dollar-yen over the last 5 days. The commercials are all in long, suggesting the bottom is in. But the market breadth is weak, and the VIX is dangerously low, which often precedes a spike in volatility, not stability.
Let's hear the weekly calls. Each voice makes one prediction based on their analysis.
The macro data is the key. With the Fed holding at 3.63% and consumer sentiment at historic lows, the Fed is likely to cut if the August data misses. However, the 10-year 3M spread is steepening, suggesting the market is already pricing in cuts. I believe the dollar will find support on any weakness in risk assets. My call, dollar-yen bullish, target 160 by Friday. I'm betting that if the initial fear fades, the yield differential will pull buyers back in, targeting the 160 level, which is the psychological midpoint of this week's range.
Technically, cable has hit its 5-day high of 1.3495 and is showing signs of exhaustion. The advance block pattern on euro-dollar and the stalling momentum in pound suggest a pullback is due before any further upside. The 1.34003 level is key support. If it breaks, we go lower. My call, cable bearish, target 1.33 by Friday. I expect a retest of the July 29 close area as traders take profits off the table following the sharp 220-pip rally.
The COT data is undeniable. Commercials are 100th percentile long across all majors. This is a flaw. Even if sentiment is fearful, the smart money is buying. The crypto funding rates are a separate issue, but for FX, the institutional flow is strong. I believe the commercial longs will defend the recent lows. My call, euro-dollar bullish, target 1.158 by Friday. I'm betting on the continuation of the commercial buying pressure, pushing the pair back toward the 1.158 area, which is near the top of the recent 5-day range.
I'm looking at the risk of a liquidity shock. The VIX is too low and the equity breadth is too weak. If the ISM data on August 3 is soft, it won't be a soft landing story. It will be a recession scare. This will crush risk assets. My call, Aussie dollar bearish, target 0.69 by Friday. The 5-day low is 0.69223. I expect that level to break as the risk-on regime collapses under the weight of bad data, pushing Aussie into uncharted, lower territory.
The big picture is a market at an inflection point. The commercials are long, but the breadth is weak. I believe the dollar-yen drop was an overreaction, and the carry trade will resume if the data doesn't crash. However, I'm cautious on the euro due to the bearish candlestick patterns. My call, dollar Swiss bullish, target 0.812 by Friday. I'm aligning with the technical strength in dollar Swiss, targeting the July 31 high of 0.81292. I expect the pair to challenge that resistance again, as the Swiss franc remains a safe haven amidst the equity weakness.
So we have a mix of views. Pulse sees a dollar-yen rebound to 160. Grid expects a cable pullback to 1.33. CIPHER sees euro-dollar pushing to 1.158 on commercial buying. SPECTER warns of a crash in Aussie dollar to 0.69. And Apex targets dollar Swiss at 0.812. It's a week of sharp pivots. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.